Hello students, welcome to week 3. Today is day 11 of our mathematical theory of interest course, and in today's lecture we will discuss the annuities, how we can use these annuities, or how we can use these mathematical formulas to find out the present value and the future value of annuities having different payments and conversion periods. I mean to say different payments, we can say that these annuities may follow unusual cash flows or uneven cash flows. And about the conversion period, different conversion period mean to say maybe these annuities may be based upon the monthly payments, weekly payments, quarterly payments, semi-annually payments, or other than yearly payments or biannually payments, we can say that. So in today's discussion and in tomorrow's discussion, we will have the discussion on this topic, annuities with different payment and conversion period. Now moving further, quickly moving, first of all, these annuities are basically called as deferred income annuities. The annuities having different payments and conversion period, they are we normally call them as deferred income annuities. We have talked about aging, retirement, longevity, and annuities generally in general scenarios we discussed in the previous week. Now, moving further, what we have already discussed? We have already discussed that risk that you live a lot longer than you expected is called longevity risk. Just like life insurance companies example in our previous class, in our previous week's discussions, when we were talking about different types of annuities like ordinary annuity, annuity due, perpetuity, and deferred annuities, we discuss about this kind of risk. This risk is called as longevity risk. Although pension, social security is protection against longevity risk, but specifically we can say that we have to make proper contributions of these annuity concept in this scenario. So deferred income annuities, for that purpose we need to calculate the deferred income in annuities. Deferred income annuities, we can define that they have one objective way to use portion of your retirement savings to protect against outliving of your money. This is how, these are the practical aspects of these annuities, deferred annuities. These are the practical aspects of these deferred annuities. The basic purpose of using deferred income annuities, that you want to make your after retirement life plan. But in order to plan this whole thing, it's not like that everyone will think like that. So we have to think like a financial advisor. After studying this course, you will be able to think this concept more broadly, and you can, at least you will be able to make your own annuity plan for your future for your future time period. You can have best personal financial management plans. Once you have done this, you will want to make sure you are using a platform like ours that allows you to compare different insurers offering side by side. So after studying this core this chapter, and after studying this particular topic, you will be able to make proper cost and benefit analysis of different insurance companies' policies. So we will not like acronyms, but we will make one exception. Deferred income annuity, we call it as a DIA, deferred income. For our next calculation, we will use DIA as a short form of deferred income annuity. So first of all, we must have to keep in mind the background of deferred income annuity. Deferred income annuity. For that purpose, we will have total 6 different topic topics or this lecture's objectives. First of all, we will explain how a deferred income annuity works. Then we will describe the carriers who sell DIA and how they differ. Then we will we will tell you what others are saying about DIA. Then we will provide more details on how to know whether a deferred income annuity is right for you or not. Whether using a deferred income annuity is a right decision for you or it can't be a right decision for you. We will discuss some standards. Based upon these standards, we can take these decisions. Then we will discuss about we will discuss some important issues regarding the deferred income annuity. And last but not the least, we will compare the different available features of an annuity, and we will develop a proper guidelines that you can use how to figure out if they make sense for you. We will discuss about what should be the proper standards that we must have to follow to make our deferred income annuity decisions more viable. Now let's start. In the first step, we will discuss how a deferred income annuity works, how it actually means and how it works. So first of all, we need to define DIA, deferred income annuity. It is basically, DIA is composed of 3 different words, and every word have their own meaning. 3 different words and every word has its own meaning. Deferred income annuity. From these words, we will try to understand the concept of deferred income annuity. Deferred, first of all, deferred. It means that after you pay the premium, you will not begin receiving the amount for at least 1 to 2 years. So it means you need to invest today to get benefits in the future. For the coming 2 or 3 years, you will not be able to get any benefit. You will not get any benefit. Your benefits are actually deferred. Deferred means your benefits are being deferred at least 1 to 2 years. Income. It means that annuity promises a payback every month or every year or every quarter, whatever will be your case or whatever you will choose. The amount of that check is fixed and will not change based on what happens in the financial market. So first of all, in that particular case, you need to identify how much money you want in future, as equal payments, equal monthly payments, equal quarterly payments or annual payments according to your requirement, and this amount will remain fixed for a specific time period. And lastly, annuity. We already discussed annuity many times. Again, this is just for your information. Annuity just means that the insurance company promises to keep paying you for a certain period of time, typically for as long as you live. It is just linked with the average life of a person living in that particular society, or maybe it's for lifetime. So annuity here, the type of annuity, if it is not mentioned because the life of every person is different. Nobody knows when he is going to die. So, and here what kind of annuity we are using? Just think about the previous class lecture, previous discussion, day 9 lecture. So this is actually the perpetuity income annuity, which is perpetuity. Now we till now we have discussed about what is deferred, what is income, what is annuity. Now with a DIA, with deferred annuity, income annuity, we are It means that we are paying today to get its benefit in future, in future, and these benefits will go on till our life. So it means that you pay a premium today, the insurance company pays you for the life starting at least 1 to 2 years in future. So this is actually the basic understanding of this concept DIA. For example, although DIA has to be deferred at least 1 to 2 years, they are generally deferred much longer. They can generally be deferred much longer, just like the example of different pension funds, different pensions or different retirement funds. Like you will pay today to get its benefit, monthly benefits, once you will get retired. Once you will get retired. So in this example, a 55 years old man, if he decide to buy a DIA, and it doesn't paying until begin paying until 80 or 85, until 80 or 85. This will be the condition. So in this particular case, the deferred annuity is deferred around 25 years. This is much longer, but this is possible. This 1 to 2 years deferred, it is like in generally we can say that, but it can be in practical scenarios, it can be much longer as 1 to 2 years. But at least this is the minimum deferred time period, 1 to 2 years. If it is not deferring 1 to 2 years, then it will not be a deferred annuity. The payment will start immediately. Deferred mean it will be deferred for at least 1 to 2 years. At least it can be more than 1 to 2 years. So first of all, the longer you let the insurance company invest your money, the more it will grow. As we discussed in the time value of money chapter, in the future value, higher the time period, higher will be your future value of your invested amount. So the same concept we will use in DIA. Secondly, the insurance company basically is acting to pool different life expectancies together. The longer you wait to start the income, the lesser worried the insurance company is that you are going to have to keep paying you for a really long time. You get better pricing as a result. So for 5 years, if you purchase an annuity at the age of 50, and if you live for 85 years, it means the insurance company will pay you for if you purchase a retirement policy and you are going to retire at the age of 60. Assume that you will live for 85 years. Live for 85 years. It means the insurance company will pay you for 25 years. If you purchase this annuity, if you defer this annuity and start it at the age of 70, then the insurance company will pay you for 15 more years. And if you start it at the age of 5 years, the insurance company will pay you for 5 years. So it means that the longer we will wait to start the income, the less worried the insurance company will be, less worried, because maybe they are going to have less payments. No, second one step, the carriers who sell the IA and how they differ. Here we will describe the carriers who will sell the IA and how their policies are different. These are the basic carriers worldwide, specifically in United States. The concept behind deferred annuities is not new, but their sales have only recently gained attention or traction. In 2001, only there was one company who is providing the DIA, and its premium volume was around $50 million. In 2003, after 2 years, the number of providers increased to 11, just in 2 years. and in 2014 it was 13, with a total volume was 2.7 billion US dollar. These are the important insurance companies who are providing DIA facility. Although the platform of DIA, these insurance companies, they are actually working more insurers on the board to make the process even better for you. How it differs, how these insurance companies are different. We can differentiate their policies based upon the prices, based upon credit ratings, based on the availability of inflation rider and calculation of inflation, based upon ability to accumulate, to commute value. We can differentiate them based upon the flexibility of premium payments. We can differentiate them based upon the joint and survivor's benefit availability and death benefit calculations, and in so many other ways we can differentiate them. Now here in the step third, we will try to discuss what others are saying about DIA. These are the different journals or these different newspapers, what they are suggesting about the deferred income annuity. These are just examples from Barron's, from CNN Money, from New York Times, from Wall Street journals. You can just have a look over that to get a more clear understanding about this concept, to have more clear understanding about this concept. So this is all about our today's discussion. I hope you have enjoyed the discussion. We will continue our discussion from here in tomorrow's lecture. If you have any question, you can ask me anytime. Thank you so much. Bye bye. See you in the next class.